morning again, everyone. My name is Stephanie Léouzon. Again, I'm with Torreya, and I'm really happy to be here to moderate the Biopharma Market Update panel at the SACS conference. I will hand it over to people on the panel to introduce themselves, and then we'll go through some slides as a starting point to set the context. Allan, would you like to introduce yourself?
Yes. Good morning, everybody. My name's Allan Marchington. I'm head of life sciences at Intermediate Capital Group, ICG. ICG is a FTSE 100 company, about $65 billion under management. And we've joined ICG at the start of this year to start its life science practice, investing in novel therapeutics in preclinical and clinical stage assets. Thank you.
Thank you, Allan. Mirjam?
Hi, good morning, everyone, and thanks for having me on the panel. I look forward to an interesting conversation. My name is Mirjam Heeb, and I'm an investment advisor at HBM Partners. HBM Partners is a European specialist healthcare investor based in Switzerland. We manage several healthcare funds, but our flagship fund is called HBM Healthcare Investments, and it's an open-end fund listed on the Swiss Stock Exchange with about $2.5 billion in assets. And so we are a crossover fund. We invest in private and public healthcare companies, and I'm on the public equity team. So I'm involved in investing in companies that are listed on the stock exchange.
Thank you, Mirjam. Sam?
Hi, good morning. I'm Sam Fazeli. I'm very happy to be back at this forum, which has become an annual event for me, which is great. I've been at Bloomberg for close to 11 years now, and before that I was on the sell side for about 12 years. I run a group, or at least the European Middle East division of a group in Bloomberg called Bloomberg Intelligence. And we do research and analysis in terms of equity and credit and strategy around the markets. The team's now around just over 400 people globally, and in London we're about close to just over 80. And that team covers all industries, obviously, including pharmaceuticals and biotech, which is my other hat that I wear. And in my spare time, I'm also a non-executive director on two UK biotech companies, Exonate and Aracor, which has recently gone public. And I'm also on the board of a SPAC with Life Science Partners. And I'll leave it there.
Thank you, Sam. Stéphane?
Yes, thank you, Stephanie. Very happy to be here with you today. So my name is Stefan Wessel. I'm chairman and CEO of SparingVision. SparingVision is a genomic medicine company specialized in ophthalmology. Our lead asset is a mutation-agnostic gene therapy that we developed in retinitis pigmentosa. We've raised 60 million euro in Series A, closed last year, and we are rapidly expanding the portfolio on the team. Again, very happy to be here.
Thank you very much, Stéphane. So unfortunately, we have apologies from Gil Barnahum from Jefferies, who was going to join us here. He has kindly, though, provided his slides. So bear with me. I'm going to walk through and try to present them as I see them, and everyone chime in. But this will just be really helpful to provide a context on what's happening in the market. So if we could have the first slide. This is an update on the US equity market, but very instructive as well for those of us in Europe. The chart in the upper left shows since January 2021 how the market has performed, and the top three lines are the overall market, the S&P 500, the NASDAQ, and the Russell 2000 index, and the dark blue line heading south, unfortunately, is the XBI Biotech Index. So it started off the year with a big bang, as we all know. February 21 was the peak, and more recently, the market in biotech has been struggling. And I think we see that over on the top right as well, where last year healthcare was one of the best performing sectors. This year, as investors are rotating away from sort of the COVID world stories into growth opportunities, healthcare is underperforming the rest of the market. What's interesting also to look at is the volatility index, this middle chart on the right. It's called the VIX. Typically, when that goes above 20, historically, it's been very difficult to finance biotech companies when the VIX is above 20. Financing a volatile sector in a volatile market, is kind of perhaps too much volatility. Last year, though, the VIX sort of broke, or the funding market sort of broke that trend. And so we had one of the biggest funding markets at the same time that the VIX was really, really super high relative to historical levels, as you can see, based on the sort of box, 2019-15, for example, that, between 15 and 20 something is where the VIX usually ranges. And on the bottom chart, it's interesting to look at, we all know that there was a really healthy biotech new issue activity, and that has slowed down quite a lot, as you can see in the bars on the bottom right. If I could have the next slide, please. This is just looking at US biotech issuance since 2013. So 2020 was a very busy year, 79 IPOs, raising about $15 billion in proceeds. 2021 year to date has already raised $13.5 billion. The little orange bars are the year to date sort of comparable, the 9-month numbers in terms of, what you would compare with. We've already had 70 IPOs in 2021, but the metrics that people look at are deteriorating a little bit. How the offers are performing, and things like that. So I think we're starting to see some softness in the IPO market, and that's consistent with some slower market issuance trends. If we could have the next slide, please. This chart looks at IPOs over the last few years based on stage of development. So the chart, for example, the brown box is 2018 and the gray box is 2021. And you'll see that over the years, there's been a very large number of preclinical companies relative to historical patterns. So much earlier stage companies coming into the market over time. And at the same time, the median, this is the bottom, median IPO pre-money valuations, have also trended up. So it's a really interesting statistic. In the past, it was very unusual for preclinical companies to be able to go public and raise significant amounts of money at a significant valuation. So that's an interesting trend. If I could have the next slide, please. This looks at, again, US IPOs in life sciences, their performance from 1 month after the offering, which would be the blue bars, and the current performance. So, excuse me, 2021 IPOs, 1 month after they had been priced, were sort of up 22%. But at the moment, they're only up 5%. So that's kind of consistent with that chart that we've seen trending down. And if we could have the next slide. Sam, you can comment on this when we come to our discussion. SPAC IPO activity still at all-time highs. 2021 raising 129 billion, in, compared to 2020 for the full year, 2021 only year to date. Say 450 IPOs on the top right chart versus 248 in all of 2020. The average IPO size in 2020 was the largest ever, so 325 million, but still in 2021, a pretty healthy IPO size of $286 million. And then since 2015, only 10 SPACs have been liquidated. We can talk about that later. It's kind of a complication of how SPACs work, but we can get into that later if that's of interest. If we could have the next slide. This just looks at the beige bar is a SPAC index, and the green bar on the top, line on the top is the Russell 2000. So SPAC returns outpaced the Russell 2000, which is sort of a very large index of tech and other high tech and life science companies in the US, but had a lot more volatility in 2021. Larger SPACs have performed better, which is what's kind of commented on at the bottom. but they have taken time to get meaningful value in the public market. So why don't we go to the next slide? Here's a list of SPAC healthcare business combinations. You see, it's interesting to look down the list of sponsors. You've got some of the best names in investors. So Perceptive, going down the list, Casdin, Foresight, Deerfield, et cetera. This is really, the great and the good are going into this process. And I guess we've got a red box around the aftermarket performance showing that while earlier in 2020, the aftermarket performances were all positive. More recently, some of them they seem to be trending negative. So that's interesting to see what that will mean for that trend going forward. And if we could have the next slide. M&A activity in 2020 and 2021. So you've got on this chart, going down the left side, you've got sort of the stage of development of the various companies when they were acquired and across over time. And so you see the bubbles, I'm guessing, look like they're the size of the transaction, relative size of transactions. And the headline is that 2020 and 2021 year to date really focused on smaller deals compared to prior periods. We still, though, 2021, we had quite a slowdown of M&A until pretty recently, if you just look at it relative to prior years. And then more recently, we've seen the Sobi deal, the Acceleron deal, the GW deal, a number of these, larger deals coming through. So that's, promising for the M&A market. And I think when investors see M&A activity, that's also encouraging for investment as well in the public markets. If we could have the next slide. Interesting point here that the number of earlier stage M&A deals has been rising. So the top chart just looks at deal frequency based on lead product. And so going back to 2012, for example, there were only 3. The dark blue part of the bar at the bottom is the preclinical. Only 3 M&A deals in preclinical, and in 2021 year to date, we've seen 7 already. Whereas the marketed deals where companies had marketed products are more or less consistent as a percentage of the deals going forward. And looking at the bottom chart, based on transaction value, again, the marketed deals are more or less consistent around 50%. But the value of the preclinical deals, has increased significantly from prior years. So that's a very interesting trend that, companies seem to be willing to, acquire early stage companies when they're trying to access interesting new technologies or targets. And if we could have another slide. That might be the last slide. Okay, so if we could stop showing the slides now, and then maybe we can comment a little bit. Sam, what do you make of some of these trends in the market? What are people talking about at the moment? Sam, you're on mute.
How many times have you heard that phrase in the past 18 months?
At least once a day.
Not necessarily Sam on mute, but just you on mute. And so, Gil isn't here, so we can't grill him. But, there were some interesting aspects in there that I think are important to look at. When we showed, and I'm not defending SPACs here, I'm just a non-executive on a SPAC. It's just it's not really my position to defend or whatever. But the performance of the SPACs in terms of the 5.1% year to date was pretty close to what the IPOs actually had done. If I didn't get my numbers wrong between the 2 different slides. So, I think that you're probably seeing the same. Once a company has SPAC has done its deal, then it becomes yet another company as if it's just IPO. Then of course the structure of when it takes a company when it does its deal is slightly different to when you've done an IPO. But it's but nowadays I think a lot of the money comes from the not necessarily insiders, but the friends and family of the company and the SPAC. So that performance seemed the same, I would say, but we could go back and check that. So that's one point. in terms of the earlier stage deals, if you added up the two colors that Gil had at the bottom, the very pale blue, I think it was, and the slightly darker blue, so preclinical and phase 1, they all ended up being about the same across the years. You would have thought that pharma, with all the talk of the biotech market's too expensive, may have gone further earlier, but it obviously doesn't look like it. Data's still talking the same. And I have to wonder, if Gil was here, I would ask him, in 2020, he was missing Alexion. It wasn't either in 2020 or 2021. Now, he may have put just some select deals in there, but...
He may have been more specialty pharma or,
Right. Well, I mean, Alexion, to me, is anyway, yeah. But I'm pretty sure he had it in there somewhere in his sums, etc. He just took some numbers. But I think in general, and I think Mirjam would be able to talk to this, Allan, etc. The complication I think people are dealing with, and I have a Bloomberg persistent chat on which there are about 1,400 investors. Not all of them obviously talk because that would be complete mayhem, but it's there's a select group that talk. But I mean, folks are inundated, are buried, are drowning in ideas. How many buy, try, multi-specific antibody companies are there out there, right? How many
I don't know how people keep up with it, to be honest. I find it really challenging myself.
I'd love to hear from Mirjam and how they manage, but you can't. So people have had to and have got to come up with new strategies as to what it is that they're going to focus on, because it's just impossible. And I think that's got a lot to do with why the market's performing the way that it is, as well as the fact that there's all kinds of other stuff going on with gas prices going through the roof and Evergrande and things that we forget about in our world. But I get inundated with, because I cover, I manage this team which spends a lot of effort doing other stuff. So there's a lot going on in the world that we don't see, and I think that's what's distracting people.
Yeah, just to comment on that, I can say that I totally agree. We feel quite overwhelmed, I think, with the number of companies that we're seeing. And so it's the sheer number of companies that are coming through IPOs, first of all. Second of all, the technologies, the spaces have become very crowded. So if we look at ADCs or IO, also rare diseases, it's not just, one or two companies that are playing around, but we have easily 5, 6, 7 companies with programs. And then add to that the stage of the programs are very early. So for me, as a public investor, I'm looking at programs that I don't have any experience in. I mean, it's been venture territory a couple of years back. And I think that was interesting on that one slide, Stephanie, where we saw the stage of the companies by, so the IPO by company as with respect to what stage they're in. And you see that the preclinical shoots up high in 2021. And this is totally what we are seeing. We're seeing companies come to the market that are still in preclinical stage, which means we have no clinical data to look at. And we have long waiting times until we get clinical data. Sometimes it's the end of next year or the beginning of 2023. So that makes it very difficult and complex for us to get our heads around. And I think it's those kind of, it's like an additive effect of complexities that then makes it very difficult for us to then pick out the investment ideas and the companies that we feel comfortable investing in.
Yeah, you don't have your usual metrics to look at, right?
Yeah, and also the other thing I wanted to mention is that these programs also are starting to slice down patient populations quite significantly. So whereas maybe 3 or 4 years ago, a program would target an indication that is fairly large, what's happening now, which is extremely positive for the patient, the industry is focusing more on biomarker-driven technologies and therapies. But what it means, on the other hand, is that we're becoming much more selective to the patient, which then makes it much more difficult for us to figure out how many patients are we talking about at the end of the day where this therapy then could be applied? And it might be much smaller than it.
Commercial potential.
Yeah.
Interesting.
Yeah, I think Mirjam's right. We're sort of drowning in deals, as it were. Our deal flow is incredible compared to what it is. You know, I've been in biotech, I've been in venture for the last 15, 20 years, as Sam knows, and I think it's a wonderful time. There's so many deals, so many ideas, so many companies. The way we've sort of done it is just said, okay, we're just going to be really strict on our criteria, and you know, we focus on neuroscience. We think neuroscience is the next wave. It's the decade of neuroscience in terms of using biomarkers, imaging to really understand it. I think oncology's still got some legs, but it's got to be truly differentiated. And then rare and orphan is where we look. And you know, as immunology comes forward, I think that's going to be interesting in terms of implementation in other areas. But we're super brutal with that in terms of the way we work about it. It's interesting on the IPOs how Stephen Hansen wrote an article this week in BioCentury. You may have seen it on the Hong Kong market. And now the Hong Kong market is now like the second area of raising capital. And it's not covered in Gil's slides, but I wonder how much competition there is now between NASDAQ and Hong Kong. And Sam, you may be seeing this, but it just strikes me whether people start looking east these days as well as looking west from Europe. The other thing, looking at Gil's slides, I wonder how many of those preclinical companies are actually European and how many are US based. I feel like the US guys can get out quite well on an IPO with a preclinical company because perhaps they're more well known. But for the normal public market investor, as Mirjam says, I think it's very difficult to judge what those companies are going to do, how they're going to perform, and you've got to hold your money with that stock for quite a long time. You know, it's a great financing event, but what do you do? You're holding it for 2 to 3 years to data and an exit, perhaps. So it's
more like a venture investment.
Sorry.
More like a venture investment then.
Yeah, exactly. Well, you know, we're looking at that, but yeah.
Just to your point about Hong Kong, Allan, you know, we have a pretty active office there, and I've got a couple of analysts in therapeutics placed active in Hong Kong, and we're hiring another one to add with pretty good backgrounds in research and science. So I've been back and forth to Hong Kong and China for over a decade now. I don't know if you remember, we engaged when I was at Piper Jaffray with HUTCHMED, or ChiMed they're called, right? Years ago, and we did a little fundraising for them in the UK. And of course, it was probably the only innovative company that had some own research in-house at the time in the Chinese market. But now they've all mushroomed. The problem with it's obviously happened this direction in that some Chinese companies with a lot of US management have listed, you know, Beijing, Zai Labs listed in the US, you know, IMAB just recently listed in the US. So there's quite a few of them, right? But I think the spat between China and the US, or at least the rhetoric, is, you know, the US constantly talking about delisting Chinese companies. And then I think that's going to probably scare people off a little bit. If, for instance, if you're referring to the idea of European and US companies raising money in Hong Kong, I think that political rhetoric might scare them.
I think that's a great point. I was just surprised at how much the Hong Kong market's taken off. I somewhat discounted it for the similar reasons myself.
Well, no, they changed their listing rules about 3 years ago. So until about 3 years ago, pre-revenue companies had a very tough time to raise money there, and they changed listing rules, and that just suddenly opened the floodgates.
Yeah, no, sure. And just want to. Sorry, go on,
I was going to ask Stéphane, as a private company CEO, probably thinking at some point about an IPO. Hong Kong, Europe, US. Do you have a view? I'm sure you do.
Yeah, quite frankly, I've never really thought about Hong Kong, and I guess you need to have some kind of a Chinese angle to your story, which is not the case for us today. Euronext and Europe in general have been through that, as you know, and it's not the best experience in my life. And so if we were to do something, but there is no such thing today on the table, it would probably be the US. This is where, and I'm stating the obvious, but all our peers are, and this is where we believe the best value we can get if ever we go public.
It's interesting. I looked at some statistics of European IPOs for the last year to date, and I think it was 2020 as well. And 70% of the money raised, in aggregate, basically for European companies, came from the U.S. And yet last week we saw last week we saw two interesting IPOs. The Exscientia IPO in the U.S., which was, a very big deal for a wonderful company working in AI drug discovery, raised about $465 million. They did an IPO and a private placement, and they went straight to NASDAQ. And at the same time, Oxford Nanopore chose to do a similar sized IPO, about $450 million in London, which is, I think, one of the biggest, that we've seen for a while. In London, at least, perhaps in Europe, in the biotech space. Is that Allan, Sam, Mirjam, as investors, any comments on that?
I think the London market is a great market. I'm just not sure it works for biotech. I think for me it's NASDAQ. We IPO'd one of our, the number of companies, but IPO Elium recently in August. August, you never IPO companies because it's a terrible time. But we IPO'd on NASDAQ. It went out wonderfully. It's great. People understand the story. It sort of works. So it's for us, NASDAQ is the market to go to. I think Hong Kong is one that we hadn't really thought about, and I've just been over the last week just looking into it a little bit more and just thinking about it. But NASDAQ is definitely the place to go. I'm just concerned with the way the markets are just coming off a little bit, whether that's still a route. I believe it will be. I think there's so much capital available and so much understanding and people in the market. I think it's a short-term blip on the back of COVID. I think we've had a wonderful time with COVID, that people have really jumped into healthcare and they're just rebalancing at the minute. It's just a slight correction in the market, given the exuberance of how healthcare is going to save the world and has made a huge difference in people's lives. The other question I had for Stéphane, actually, just on Gil's slides, was really about SPACs. And you think about NASDAQ, you think about Hong Kong. Do you think about NASDAQ? Do you think about a SPAC? There are more SPACs out there than companies, perhaps. That's a slight exaggeration. But you know what I'm saying.
No, we are very, we will be very pragmatic. And again, at this time, there is no IPO on the table, no SPAC on the table, nothing really on the table except possibly a new private fundraising next year. So we are open to SPAC. We are open to, a credible reverse merger story as well. Plan B, very likely at one point will be, NASDAQ IPO. But again, if there is something that makes sense on the table coming from a different animal, somewhat less traditional, like SPAC, of course, we'll be, looking into it.
Okay. And Sam, what are your thoughts on the SPAC and just the redemptions that are occurring in some of these recent SPACs? Do you think that's just a blip, and you think it'll settle down and those people, because a lot of investors now are using it as optionality. They invest in the SPAC, and then if they don't like the target, they just redeem at the end.
Well, I think you have to accept that that's actually a positive aspect. And so if that happens, the investors have not been properly vetted and informed. I'm not saying they're misinformed, but the SPAC every SPAC has a strategy that the investors buy into, but so aside from the strategy, then you go and try and find a target, right? And when you have that target, that you hopefully have had some within the limits of the law, or some kind of interaction with your shareholders in terms of what the future holds for them. So you should really not get surprised by massive redemptions. And I think if you look at and I have to say I haven't got the analysis at hand. if you look at the SPACs that have had major redemptions after the announcement or the other deals, it's not necessarily the specialist type that who have been driving a deal or have been backing it. It's been more of the generalist, you know how many flavors of SPACs there are out there, right? So I think when you look at it that way, I'm not that bothered. The problem, of course, is finding the right target and make management, and it varies. The interest of management in SPACs varies from day to day, and obviously nowadays is probably going to be going higher, right? I think Oxford Nanopore and Exscientia, in terms of their fundraising, which I'm very, very pleased for them, both incredibly interesting companies, but also Oxford Nanopore has been a long time in the making, but they have characteristics that makes them very interesting to people, not necessarily in the healthcare space, right? So Exscientia, I think, attracts the interest of more of the tech kind of investors who like that kind of space. And of course, Nanopore has a business, right? I mean, they're doing, I don't know, a meaningful chunk of the COVID tests around the world, right? So sequencing that's going on. So those are from a SPAC perspective, it really, I think, is very dependent on exactly each story and what kind of investors have been in it.
No, thank you.
Yeah. I mean, what I really am trying to get my head around, look, we've all celebrated the amazing evolution of science and how rapidly our understanding of immunology, neurobiology, cancer, which of course I have a very close relationship with folks at Johns Hopkins for obvious reasons. Michael Bloomberg is a big benefactor there in the immuno-oncology space. And I remember talking with Drew Pardall, who says basically to most of apparently his opening when he teaches is everything is about immunology. If you're talking about bone disease, cardiovascular disease, cancer, neuroscience or neurology, or everything is about immunology. So at the end of the day, that's the depth of understanding that's evolving. And then each area, each new technology. I was just reading a beautiful paper about adeno-associated viruses that research that's coming out of the Broad Institute, which I'd be amazed if it's not already a company, how to try and meaningfully increase the tissue specificity of these viruses for gene therapy. So it's so much science, and we are all excited about the science, which of course then translates into so many companies and so many ideas. The question is, how do we manage the indigestion that we're dealing with as investors, as companies who are private, and those who sit on the sideline and comment about it, like me, right? What's going to happen here with the 500 companies that are out there? Pharma can't buy them all. Do we have to think about Allan, Mirjam, in the investing side, creating a structure where you go and do a roll-up when they're all partly on their knees, but already still have phenomenal technology and ideas? We can't just wait for pharma companies to do the acquisitions, etc. So just interested in actually how do you prognosticate? What do you think how are we going to deal with this overload?
Mirjam, I'll take it. I'll have a first go. So Sam, I think you're exactly right. I think for me, one of the reasons that we joined ICG was really about joining a bigger institution with a bit more muscle and a bit more capability. And that really comes back to your point that companies, I think those that will survive and those that will get rolled up are the ones that are well capitalized and in a good place. And so what ICG gives to us is the ability to actually do things a little differently and allow us to put more capital to work and more capital into companies to carry them further to then have the opportunity to roll up. But I think your point is really well made is what is going to happen, because the regulators aren't going to approve there's, an ADC for the same disease, the 10th, 12th ADC, they're going to get, some on the market, and that's going to be it. And people are going to lose money in some of those deals. So there may be a slight correction in it, but there is an opportunity to roll up and mitigate. And I think that sort of drives you to bigger players who have got a lot of capital to put to work. That's somewhat basic, but that's sort of my thinking on it and what we analysed when we joined ICG. Mirjam.
Yeah, maybe I agree with everything. What can I add to that would be that I think in part, maybe the complexity will resolve itself, as you indicated, Sam, when, a lot of these companies start to go from preclinical to clinical data sets that, that's just biotech, and that's the risk of biotech, that then translation, that doesn't work. So then, those programs get eliminated. And I think that it's very important for companies to be set up financially, as Allan said, to be able to weather those storms, because we know it's not a straight line, and sometimes the program fails and you have to have enough resources to continue on with maybe another program. So I think it's maybe a combination of both, looking down 12, 24 months from now, that, the landscape will have become a bit easier just by way of who has made it through and who hasn't.
Yeah, I think the other thing is, of course, we're in a maturing industry, aren't we? The pharmaceutical industry in reality has only been around for 70 years. It's not actually that long. It really isn't that long. When you look at other industries, it isn't that long. And I think the models are changing. And I think the way pharma's operating is more and more outsourced. And, you wonder how far it's going to get pushed to the biotech industry as the feeder for the farmers, that it goes even more so. I know more than 50% of the products now that pharma are putting out are from biotech, but is it going to go even more that way? That's going to need more companies, more innovation, because it's just more inventive within biotech. I think pharma are wonderful and have got some great, I don't take anything away from pharma saying that, but the biotech and the small companies and brings some different types of energies and different ideas. And so it may be that there is capacity to take all these companies and all these ideas as pharma starts getting created as well. I think that's the other side of the coin.
Maybe something just, Stephanie, you're on mute.
Yeah, sorry. Go ahead, Mirjam.
Yeah, I just wanted to mention that I think, something we haven't talked about at all, and I think is really important to just be cognizant of, is we've had a lot of innovation, but the FDA has been very pro innovation in the last, I'd say, 5 years, right? We've seen really an acceleration with the FDA, really promoting getting these innovative therapies to the market and to patients faster. And what I've just observed this year is that the FDA has become much more difficult they've slowed down on that front. And I'm not sure if that has maybe in part to do with the COVID situation, that there's a lot of absorption for them dealing with this sort of pandemic crisis, or whether, we've kind of pushed the limits of how fast can therapies get approved, and they're being more careful on one side, but on the other side, a bit more difficult for us as a company that are developing programs, or for us as investors to really be sure that the therapies that the FDA will give the green light with approving these therapies. And I think that that's something we should keep our eye on. And I really hope that reverts back to normal over the next 12 months, because I think that's key for our industry, actually, to continue along this line of productivity that we've seen over the past years.
Well, I'm sure Allan's very happy with their actions in the past 9 months with approving Aduhelm, because that kind of made everyone suddenly start opening up their checkbooks to neuroscience or neurodegenerative names, despite the fact that Aduhelm has obviously faced all the problems that I think everybody expected it would face, because the data are just, let me put it this way, complicated.
That's an understatement, yes. But I must admit, we're excited about the Aduhelm approval, but I think we're also cautious and recognise there are complexities with that. But it's been great for us in terms of neuroscience. We're excited about I think neuroscience is a great space and a real unmet need. The other thing, so Mirjam, I think you raised some great points about the regulators. I think they drive a lot of our industry, and you've got to know that you're going to get the regulators are going to approve your drug, or or positive towards helping with the studies and the trials and the adaptive designs and everything else that we need to do. So I agree completely with that, and that to some extent pricing in the US goes to the same way, doesn't it? We've got to know that we can sell these products at the end of the day, and that's sort of a big one that's hanging out there at the minute. And I guess that's what maybe has hit some of the recorrection on the markets that's happening at the moment.
Yeah, certainly. Sorry, Stephanie. Certainly, the democratic noise about drug price control. I mean, the kind of things that are being proposed are back to the very draconian measures with regards to international pricing index and Medicare negotiation, etc. But I think the market just doesn't want to accept that it's not the first time they've heard these things, right? Getting those things through is tough, but I think the industry itself also needs to just think a little bit hard.
So I think we're back, and maybe I'll just re-ask the question because we might have been cut off in the middle. I just was noticing that in the last 2 years, there's just been a huge amount of money going into the private sector, and I was thinking about what are the implications of that. Is it bigger rounds? Is it more companies to invest in? Is it keeping companies private longer? Allan, I think you had some thoughts on that, obviously coming from that world, and maybe Stéphane and actually everybody probably has some thoughts on that.
No, so I for me, I think there's lots of companies out there. There's lots of excitement and lots of opportunities. I think I see that in the trend in the market is the Series A's are getting bigger. As we think about it, we're thinking about really capitalizing our companies very well, giving backing really top class management, and I think there's loads of great management now in Europe to back. Give them well capitalized, give them the money to really explore not only their main products but the products on the edges as well. Explore the other ideas, but take them to those key value inflection points. So years back, I know we didn't have the slide, but the Series A's were much smaller, and I think we're all seeing much larger Series A's as we go forward, and we're behind that. So our typical ticket sizes in companies are increasing significantly in terms of where we're looking at it. So we're looking, 20, 30, 40, $50 million per company as we think going forward into our businesses, and then also maybe holding them longer. So holding them to the point where you can really maximize the value, because when we're doing these bigger Series A's and bigger Series B's, the multiples that we need to get out are much larger. So your exit valuations have got to be much higher because that much more capital has gone in. If you only put 30, 40 million in, getting a 3x at 150 million is not so hard. 4x, 5x, whatever the number is. When you've put in 300 million, getting your 4 to 5x, you're in that 1.5 to 2 billion range. And so that's something that's going to drive things as well.
Let me just divert for a moment, because I know Stéphane has to leave with our various delays. We're running over. But Stéphane, given everything you've seen, I mean, you've built companies in Europe, you've sold companies to Americans, you went and lived in San Francisco for a couple of years working at Sangamo, you're back doing a new company in France, one of our most successful serial entrepreneurs in Europe. Do you have some advice for the audience, people in your position, maybe just starting out?
Well, yes, certainly, but I don't think we'll have time to give
it all.
I just wanted to bounce back on what Allan was saying, because I think this is really touching what I believe is one of the main reasons why we've been far less successful in Europe than in the US, which is the access to capital. And we've always been working with less than in the US. And the good thing is that our cost of doing business was obviously lower. We were probably more efficient at spending cash on a given project, But the biggest disadvantage, which again is, I believe, is one of the reasons why we are lagging so far behind the US, is that we had a tendency because of that to put all our eggs on one single project. And as such, we were very efficient in working on that project, but this is a binary world. And most of the time we are failing, and so we were efficient on a given project up until it is failing or succeeding, but we were less efficient at building company for the long run. Because in the US, you have a larger amount of capital, so you can do many things and you don't put all your eggs in the same basket. So the situation that you are describing and that Allan was reflecting on is, I think, something that could really change in a very positive way the European landscape. We need more money, and we need more money because, again, this is a binary world, and we need to have multiple eggs in multiple baskets. And also, this is leading me to the next comment. And my final comment is that one of the other issues that we have in Europe, or that companies have in Europe, is that it's difficult to attract, very good C-level talent because, again, the money is in the US and talents, they go where the money is. So if we put more money at play in European companies, it would be easier for us to attract talent from the US, in the US, coming back to Europe, because you won't attract, let's say, a C-level person living a comfortable life in San Francisco or in Boston with a 10 million or 20 million euro Series A in Europe. That is never going to happen. You will attract that person with 100 or 150 million euro on the table. Okay, I'm very sorry. I need to go. That was my final comment. And I will
Thank you very much.
Yeah. Take care.
Thank you.
Bye-bye.
Thanks,
Take
Stefan.
care.
Bye.
We have a couple of questions from the audience, so maybe I'll pass those on. One question is, can you comment on the Biden drug pricing plan and what it means for biotech innovation potentially? Is the US subsidizing the rest of the world by paying higher drug prices? Who would like to have a crack at that?
I'll give it a go. To start with, Allan, I think I'm pretty sure if we go and look at a recording of a panel 20 years ago, the same conversation would be out there. Is the US subsidizing? Well, as we've all just said and read, a large amount of that subsidy goes back into the US economy in terms of jobs and R&D and investments. Now, I have no interest in pushing the pharma interest, right? One of the nice things about being a ringside commentator is that I have no axe to grind, especially at Bloomberg, because I don't have corporate clients and I don't need to worry about that. The problem is the administration is proposing the sorts of ideas that would be exactly what you expect from a hardcore democratic administration, right? The problem with getting it through is that it's that is the reality then arrives in terms of getting the votes, etc. But part of the issue is that the US system is so broken in terms of the delivery of healthcare and its relative equity that you can't. They're trying to focus it by looking at an area which actually should be the way that they save it, and unfortunately, politically, much more useful, if you like, for point scoring, to have a go at large pharma companies because everybody likes to think of them as profiteering. You can't tell people, well, I'm sorry, but the hospital is it, or the middleman. Nobody knows who these middlemen are. It doesn't resonate with the voters. Pharma companies resonate with voters. So the way to fix the problem, and there is a problem that has to be fixed because there isn't availability of healthcare equally to everyone, and we all know what happens when you end up in hospital in the US if you don't have insurance, et cetera, et cetera, et cetera. And then, of course, the out-of-pocket costs of drugs. There are things that have to be fixed with drugs, but not this way. And that's the issue. So in reality, I think we will continue to be talking about this. And I promise you, Stephanie, in 4 or 5 or 6 years' time, this panel with another administration will be talking exactly the same things.
Okay, thank you, Sam. I'll just read one more question that's come through, which says, how has the FDA decision on Aduhelm changed the investment perspectives are biomarkers now the new benchmark? Or have biomarkers become the new benchmark?
I don't think that they're new benchmark. I don't think so. So for me, it's a bit of a fudge, isn't it? I shouldn't probably say that on record, but it is a bit of a fudge. How can you measure plaque levels in a disease? It doesn't really make it. You can join the dots, but you're literally joining the dots, and you're making some big assumptions about the plaques and number of diseases. I think you need to see in clinical studies, you really need to see patient benefit for me. But obviously the trend has been set. And so for the next few years, we may be able to use the biomarker data. But in our companies and the companies that we invest in, I think in any clinical plan, we'd want to see real impact in disease. And it's got to be a big impact for us to really make a difference.
Any other thoughts, Sam or Mirjam? So going back, Allan, to your comment about larger rounds and keeping companies private longer, it was interesting because I think I started saying before I got cut off at one point that I looked at the last since 2020, I think, the sort of 15 or 16 larger sized M&A deals of European companies. And what was interesting is only 3 of them were public. I think it was Sobi, GW, and Biotest. And the others like Candy and Kymab and Mir and Arvel, those were all private companies. Is IPO perhaps not necessarily the best route? Is it better, especially with all this money in the private world, to think about perhaps staying private?
For me, it's horses for courses, as they say, is that a company that needs, some companies run clinical studies and they need to be super well capitalized. So for example, our company Elium was looking in depression, looking in large trials that need really public investor money to really run those trials, and great management team with lots of ideas. And so we recognized that we needed to raise quite a lot of capital to build that business. And so going public was the most appropriate route there. For me, my preference always in terms of an exit from companies, and that, as an investor and for my LPs, that's what I'm always thinking about, is how I'm going to make money as well, is the private M&A. They're much more attractive. The valuations are much easier. You're not in control of the public market. We haven't got the public market vagaries of ups and downs. And so the M&A, for me, it gives you much more certainty and much better understanding. So for me, it's M&A every time. But sometimes when you're building a company, you just need access to capital at a much higher rate, in the hundreds of millions of dollars, which is what the public markets gives to you.
Interesting. Sam, is that a trend that you've picked up on?
Well, yes, obviously. I mean, just looking at the numbers, Stephanie, you see that exactly what you just said. So investors that I deal with, most of them investors in the small to mid cap range, of course, everyone's thought that this year we're going to get M&A and that's going to solve our problem in terms of stabilizing the markets. And then so they get a private M&A and they go, well, that doesn't help me. And then another private M&A, that doesn't help me. Unfortunately, Acceleron happened and everybody thought, well, okay, there you go. There's a deal and it's large enough. So you can't say it's $1 billion deal, 11, 12 billion. And maybe it will go bigger if Avora Capital can get their way. And who knows? But then nothing happened again. So I think that everyone's realizing, which is what we've been talking about, is that we've got a situation which is not going to be solved by, well, it will be eventually if every company is bought by pharma, but it won't, by M&A. But that this indigestion is something we just have to live with for a while and let it pass through our systems. So, but certainly, and I suspect that we'll get some more because I think it's a lot easier to, well, actually, that's not true. Is it easier to negotiate a deal with a private company than a public company? Because with a public company, you've already got a share price and you can't go and offer less, right? Or a 10% premium, whatever.
Yeah, that's the problem. Your valuation is set, and there's only some boundaries you can go to get that exit on the public market.
Mirjam's company, you guys have both private and public, right?
Yeah.
So it's interesting to see what you're seeing in there.
Yeah, I mean, I think what I would say is that I totally agree with Allan's comments on that. I think, you know, it's not so much a question, do you stay private or do you go public, with respect to how does that feed into the potential for M&A. I think it's more a question about valuation and timeline. So what we've seen now is that with this massive inflow of money into the venture or into the private space, the valuations go up. And so then when the IPOs happen, the value chain has that the public investor gets, and also the potential buyer has to be able to pay a premium to that shrinks, right? So I think that what's important is for the companies to be very thoughtful about and very cognizant about the valuation rounds they do and the value behind that. And then very importantly, what Allan said is that the timeline of how far the cash financing is going to reach, because the most difficult position for a company is to do massive financing, do an IPO, the valuation. So then when they IPO, the valuations are so high that the new investor is investing in a preclinical stage company at such a high valuation that it's difficult to see how that investment is going to give the public investor a return, and then the company buying them has a difficult time paying a premium on top of that then makes everybody happy. And so I think that would be sort of my 2 cents on that topic, that I think it's an individual company by company specific topic, but that it's very important to think about timing those rounds and the size of the rounds and the timeline, so such that, you know, the type of investor or the type of exit then can be planned properly.
That's really helpful.
That's a great point.
We have time for one more question. If anybody has questions in the audience, put them in the chat. Otherwise, any parting words of advice? Allan and Mirjam, for companies that are trying to find a way to reach out to you, what's your best advice how to get through? Because you guys must get thousands of emails a day.
That we have really an overflow of requests for meeting new companies. I think that like having a very clear, the company should have, you know, spend a lot of time trying to really get a very precise and simple, if possible, message across. I think in the first meeting, that's sort of key. And then afterwards, it's really the data behind, seeing, you know, whether that's preclinical, phase 1, phase 2, just having really clear, concise data sets in their slides that helps us very quickly become interested in doing more work. Because usually the first meeting, it'll be an introduction. It has to, the purpose will be to get yourself apart from everybody else. And I think it's just a clear, concise message, simple, and then maybe some data sets that, you know, can back up that message.
And in the context of the landscape. Right. Allan, any advice?
No, I think Mirjam's dead right. For me, it's about being really clear. It's about the data, and it's about understanding your value inflection points and the amount of realistic estimate of the amount of capital to get to those value inflections and beyond, and where the likelihood of the exit's going to come as we look at it. Yeah.
Well, that's great. Listen, thank you very much, everybody on the panel. Thank you very much in the audience, and take care. Bye-bye.
Thanks.
Thanks, Stephanie. Well done.
Thank you.
Yeah,
Bye.
fantastic. Good job.